What's up everyone, Dylan here. I wanted to hop on for a quick analysis video on yet again another shortened holiday week. Tomorrow, New Year's Eve, is totally normal in terms of the schedule for the stock market, right? It's open. But then the following day, which is Wednesday, New Year's Day, the market will be closed, okay? Another thing I wanted to mention was that I finally picked the day for the live webinar. I'm going to do it next Tuesday, January 7th at 7 p.m. Eastern Time. If anything changes, I'll let you know, but that is the definitive plan that I have for the time being, okay? So, a lot has been going on in the market. The market has been getting sold on rallies during a time where a lot of people are bullish, right? Because seasonality-wise, since 1969, the last 5 trading days of the year, combined with the first 2 of the following year, have yielded an average S&P 500 gain of 1.3%, which is a period known as the Santa Claus Rally, according to the Stock Traders Almanac. And then on top of that, Geiger Capital on Twitter said during the Santa Claus Rally, it was down last year, but has only been down back-to-back years twice since 1950. So seasonality-wise, and the fact that last year was down, a lot of people thought that this year was going to be bullish. And I'm not saying that the next few trading sessions aren't going to be up. I'm just saying the positioning has been, more than likely has been positioned for the upside, and it has been quite disappointing. Okay. As of today, this was the first back-to-back 1% losses for the S&P 500 since August decline. Okay, so since August, there has not been a back-to-back 1% down move, consecutive days in the S&P. So clearly, like I said, the Santa Claus rally has not been active so far. Okay. So let's talk about what we went over last week, and then we'll kind of get into where I'm looking at going forward. So last week I said I expect the S&P to ultimately come up to this area to the upside, and that area was 6110 to 6120, okay, which was previously deemed as very, very strong resistance before the move on Wednesday, December 18th. Stopped bouncing there, and it simply broke down aggressively. So I'm going to go ahead and draw this 6110 to 6120 area, right? This is what I went over last week, and you could see, like I said, before that large move on the Fed event December 18th, this was clearly, a key support area where the bulls were able to defend several times across 3-4 different sessions over like a 2-week span. Okay. Then we moved on to break it to the downside on that Fed event. And I said last week, hey, that is ultimately my upside target on the S&P, where we have to assume that that's going to then act as resistance, as it was previously deemed as strong support. It did not get there, right? It got 2.5 points away. So it ended up topping out at 6107.5 before making its move down. So, Dylan, what's been going on? Why have we gotten this sell-off in the last couple trading sessions, or last few trading sessions, from peak to trough, over 3%, when seasonality-wise, we're supposed to go up for the Santa Claus rally, right? What's been going on? A few different things. There hasn't really been a very, very clear headline per se, but I got to mention 2 things. This is from Adam Crisafulli today, this morning. He said, keep in mind that trading is characterized this week by extremely thin volume, liquidity, and attendance, which creates a lot of air pockets, exacerbating moves in both directions. Okay, so the fact that it's such a thin tape for the shortened holiday week, the last week of the year, right? A lot of people aren't trading. The volumes are thinner. The tape is thinner, right? So any move up or down can be exaggerated, okay? On top of that, this is from a Goldman Sachs note last week and today, right? This I'm just reading it word for word, word for word. Goldman's trading desk estimates that there was or was a $21 billion U.S. equity order to sell from U.S. pensions, given the moves in equities and bonds, lately. Putting this in context, $21 billion of worth to sell for the equities from the U.S. pensions ranks in the 86th percentile going back to January of 2000. So over the last, call it 25 years, this is in the 86th percentile of the largest amount to sell for pension funds during this time span. And like I said, you take that with the fact that there's thinner tape and thinner liquidity, and you'll get moves such as the one we've seen over the last few days. Okay, so the issue with this statement that I just made for the pension fund sell order is we don't know if it's finished. I don't know if they're done with the 21 billion. Maybe the last couple days they've sold all 21 billion dollars worth of the estimate. Maybe they still have 10 billion to go. I don't know. Okay, and that's why it's like, on one hand, I'm telling you what I've seen to, back up what we've seen in the market the last couple of days with the last two consecutive 1% down moves. But then on the other side, it's like, how does that help us? I don't think it does per se. So, take what you want from what I just said, and that's what we're working with. Okay. So if this move to the downside continues, where would I expect bulls to step in? Okay, to start, I want to talk about that 100-day moving average again. For a reminder, that 100-day moving average was able to support price back on last week, or not even last week, a week and a half ago, on December 20th, which was a Friday. That 100-day moving average basically marked the low of that large down move that followed the FOMC event. Okay, so going forward, considering how well it supported price a week and a half ago, I definitely, you'd be stubborn not to look at it again if the S&P gets down there. Okay, so that line, as I'm saying this, is sitting at 5907.5. So keep an eye on the 100-day moving average on the S&P futures. Because it's worked so well the last test, I would definitely keep an eye on there. Okay. On top of that, let me just mark that for the time being. 5907.5 is where it lines up with. Okay, so 5907.5. We'll use we'll mark it as 100-day SMA. Okay. So on top of that, I also want to point out this key trend line. Okay. Spanning from the August lows, I'm going to match that low to this low from a week and a half ago, December 20th, and you could see that general area lines up with that 100-day moving average, assuming it hits on Thursday, right? So I would definitely keep an eye on that 5,900 to 5,910 area, where the trend line and the 100-day moving average coincide. And that's a really good spot to gauge overall strength and weakness, because on one hand, if it bounces, right, you can take a trade off that, right? Good risk reward there for a, counter trend bounce move. And then on the flip side, if it doesn't hold there, right, you can use it as a good area to lean on to potentially, go for a short, or just in general have an understanding that the market is relatively weak overall, and that we can assume that this low will then be broken if that general area breaches, and then the sellers defend pops below that area. Okay, so that's definitely going to be a very, very, very important area to look at. On top of that, we could use that same reference point to draw the same trend line on the Nasdaq, which should also align with the S&P trend line. Okay, So I would definitely keep an eye on this Nasdaq trend line as well, using the same reference point. Okay, so to the downside on S&P and the Nasdaq going forward in the near term, right? 100-day moving average S&P, right? The futures, which should coincide with that trend line. And then if you want to add additional context, use the Nasdaq trend line as well. Okay, so that's where my head is transitioning to if this downside pressure continues. Okay, now on top of that, we could use the VIX futures, right? You guys know I love my VIX futures. To the upside, right? If you're a market bear, you want this thing to break above to the upside, gain traction, and ultimately start to really, really trend higher, which will ultimately put more pressure on the S&P. So I will use this trend line going forward on the VIX, just taking the Friday, December 20th high and latching it onto today's, right, December 30th high. And we essentially get a line that lines up with, call it 18.25 going forward. And because it's a descending line, as time progresses, that line will get lower and lower and lower. But, you got to mark it on your end so that you can follow it. But I would ultimately follow this trend line, okay? And then above that, today's high. But ultimately, that trend line, I think, will give a pretty good gauge of where price is heading next. So, like I said, if you are a market bear and you are betting that the S&P is going to go lower, what do you want to see? You want to see this general area get breached, right? The 100-day moving average plus the trend line. You want to see that area get breached, and you also want to see the VIX breaking out of this, above this trend line and above today's high. And if those two things occur at the same time, that would give you the best chance that the downside pressure will continue. However, if the S&P bounces at that general area that I just went over, the Nasdaq also tests the trend line support, right? S&P, Nasdaq, and the VIX fails to take out either the trend line or today's high, that would ultimately give the bulls the best chance of defending the dip. Okay? Very, very simply put. Hopefully that makes sense. To the upside, I'm going to look at the anchored VWAP from the December 26 highs. You could see it already acted as resistance one time on last night's Sunday reopen. And, since then it has fallen to the downside. So going forward, if this thing wants to bounce, I would use that anchored VWAP to kind of gauge, right? If the S&P can break above it and sustain value above it, that's a good area of support, right? Resistance that will turn into support going forward. If it fails there, like it did on last night's reopen, it will probably, roll over and fade back to the downside. Okay, so hopefully this gives you a pretty good idea of what I'm looking at going forward in the near term. Like I said, tomorrow, totally normal day with scheduling, and then Wednesday we have an off day, and then Thursday, Friday back to normal. Okay, so that's it for me. Very, very short, very simple. Like I said, again, January 7th at 7 p.m. Eastern Time next Tuesday, live webinar. We'll do some charting on there. We'll go over a few things like I would in this analysis video, and then we'll do probably an open-ended Q&A as well. So looking forward to that, and that's about it. If you like it, give it a thumbs up, comment, whatever you got to do, and I'll talk to you guys soon. Peace.